from LGT Wealth India joins in to talk more on the markets and his preferred ideas as well. Chakri, good morning. Thank you for joining in. Season's greetings to you, your team, your family. Wishing you as well a very happy new year. Where do you head into 2026? We are on course for yet another earnings season. What are your anticipations for this time around, considering the fact that we'll be on a lower base? And do we believe that a double-digit earnings growth is a realistic possibility now?
Good morning. Thanks for having me, and a happy new year to you and to your viewers. It's been a roller coaster ride in 2025 with the amount of uncertainty of global events and tariffs and its impact on India's corporate earnings. And therefore, the earnings fell to single digit, about 7-8%. And now the expectation is, as we go into the next year, there will be some kind of a resolution, hopefully, of the tariff deal. Now, as and when, if that happens, we expect a fairly significant earnings upgrade from single digit to well into double digit, maybe 13-14%. And that would lead to a market re-rating as well, and and the corresponding FI influence. So I think that is the biggest catalyst that we're looking out for as we step into 2026.
Okay, well, Chakri, IT has been a bit of a laggard in 2025. Do you see a bit of a tactical trade linked to some of the rupee weakness we've seen recently, or in your enduring growth basket, does it deserve a place?
I think IT is actually well positioned as we go into 2026 because, if you look at all the hyperscalers in the US have spent about $100 billion almost every quarter for the last few years now. And all those applications now need to be integrated, AI infrastructure applications. And those AI infrastructure applications need an underlying IT services model. And that's where the Indian IT services companies come in. They have lagged. We've seen this before in the cloud rollout a few years ago. IT services dipped and then took off. The same way we expect an acceleration of earnings going into next year.
The consumption space. A lot of people believe that with the kind of measures that the government has taken over the last 6 to 8 months, the pivot has been towards reviving consumption. Do you think any of the listed large staples players benefit from this? Or would you believe that, they're mature and growth is not one of those things that they will lead from when it comes to increase in consumption, and that will go to other forms of consumption?
That's a good question because, a couple of things have happened. One with the GST cut, it affords higher spending power to the hands of the consumer. And that spend seems to be going towards the durable spends. Buying a bike, buying a car, or buying durable goods like, ACs, or even wellness that you're talking about. Whereas on the other hand, the pure FMCG companies, the levers of the world, have not been able to improve their pricing power or margins. So I would focus on more the durable bit as well as specific plays like wellness in the FMCG part of the business. In the staples part of the business.
Chakri, the sector of this month possibly has been metals, without a doubt. And with the kind of volatility seen in gold, in silver, does that as a haven asset or a hedge still deserve a mention or still deserves presence, considering the very sharp up move and now the equally sharp down move that you are seeing today in silver prices? And corresponding to that, in a lot of these metal names as well, they've gone up 50, 60, 70% this year, some even 100. Does metals still remain a cyclical, tactical play, or are we in a proper commodity super cycle and this is here to stay?
I think if you make a distinction between gold and silver on one hand and the non-gold ferrous and non-ferrous on the other, gold and silver clearly, have gone through the roof, up about 70%, gold and silver much more, 120, 130%. Against that backdrop, the shortages in silver production exist. So therefore, I think there is that structural move upwards because demand is greater than supply. On the other hand, the regular metals, which are the companies that we invest in, those companies will benefit and they will continue to do well because both the globe, US is cutting interest rates, Europe is trying to revive, India has also cut interest rates. So all these things help cyclical companies. And as we see a greater emphasis of manufacturing come back, capex come back, these companies will benefit.
Well, Chakri, in your note, you say financials will drive nearly half of the incremental index earnings over FY26 to 28. Some of the cues that we're getting, it's a bit mixed on credit growth. Some of the margin pressure may remain, given the low interest rate regime. Mixed cues and asset quality now nearing decadal improvement, but some stress perhaps still remains on the MFI side. Where do you see the better risk-reward play, particularly in the financial space?
That's a good question. If you look at financials as a space, both banks, NBFCs, across board, all kinds of companies, these are the first beneficiaries as the economy revives. The economy clearly and corporate India as earnings has been only about 7-8%. And as we go into next year, that cyclical improvement, the first credit growth from whether it's a government or a consumer or a corporate spending comes to financial services companies. And they are a large sector, and therefore we think that they will represent nearly 50% of the incremental earnings of the overall index going into next year. And the growth will be led by PSUs, NBFCs, and the big private banks.
All right, Chakri, thank you so much for joining in. PSUs, NBFCs, and some of the private banks are the earnings-based stocks that you like, you believe will drive earnings. As we speak, a bunch of stocks buzzing around as well. SBI Card, for one, has moved to the high point of trade. We have Whirlpool, which has spiked. Whirlpool obviously has been a serious underperformer in all of 2025. We'll take your leave on that and wish you a very happy new year as well. Take a short break, come back. The year is over, but business is not. We'll tell you auto sales for the month of December. They'll be released starting tomorrow. What is it that the street is working with this time around? Stay with us.